In today's video, we will break down 7 movies that are not just cinematic wonders, but also hold invaluable money lessons. We've all encountered this situation, the desire to learn more about managing money, only to find that much of the available information is just so boring. However, you don't have to rely on outdated books from 4 decades ago to enhance your financial knowledge. While these books might contain valuable insights, movies offer a surprisingly engaging way to learn about money. Pick some tips to help you build wealth and become more financially savvy. At the least, these films can positively influence your perspective on money. Ready to dive in? Let's get started. Number 7, The Money Pit. This 1986 American comedy showcases the consequences of neglecting thorough research, which resonates with real-life instances. The movie follows a couple portrayed by Tom Hanks and Shelley Long, who hastily purchase a house under pressure. After the purchase, they discover the property is in worse condition than anticipated, requiring costly repairs they can't afford. Their experience highlights the dangers of trusting persuasive sales tactics and emphasizes that buying a house extends far beyond the initial deal. Ultimately, their lack of financial planning leads them into trouble. Debt remains a significant issue in the U.S. Recent data from the Fed's household debt, and credit survey reveals that Americans owe a staggering $1.1 trillion in credit card debt as of the third quarter of 2023, a record high from the previous quarter's $1 trillion. This aligns with the movie's lesson. Planning purchases and maintaining a solid financial strategy is crucial. Making unplanned purchases can result in substantial debt over time, whether for a house, a car, a vacation, or even more minor expenses charged to a credit card. To avoid such pitfalls, it's wise to plan. Start by listing all the expected expenses linked to your purchase. This includes any unexpected additional expenses that might come up. Once you've outlined these expenses, determine where the funding will come from: savings, a loan, or another financial source. Additionally, before proceeding with the purchase, save up extra money equal to a few months' payments. These additional savings act as a safety net, helping you cover any surprise costs that might crop up after you've made the purchase. It's about preparing yourself financially and having a backup plan in case things don't go exactly as planned. Number 6, Up. In this animated movie, Carl and Ellie save up for their dream trip to Paradise Falls, but continually tap into their savings for more immediate needs. When Carl finally plans the trip as a surprise for his wife, she falls ill and passes away soon after being hospitalized. This 3D fantasy comedy provides an emotional insight into human experiences while offering an important lesson about managing personal finances. Money holds the potential to fulfill our desires, yet its effectiveness relies on how we manage it. In the movie, Carl and Ellie repeatedly dip into their emergency fund because they lack separate savings for different purposes. This behavior is generally discouraged by financial experts. Instead, they advocate for maintaining individual funds dedicated to regular savings and emergencies. These separated funds can provide a safety net for family and medical emergencies, unforeseen expenses due to job loss, or impromptu trips. Thankfully, many banks now offer the convenience of opening extra savings accounts online and setting up automated transfers, which can be easily managed through banking apps. It's a valuable convenience we should make the most of. Up also emphasizes the value of medical insurance. Having this insurance reduces the need to rely heavily on emergency funds. While regular premiums are still required, insurance coverage lessens the burden by not requiring you to cover the total expense in case of medical emergencies. The overall lesson in this move is to save for the future while avoiding depleting your emergency fund whenever possible. Number 5, Wall Street. Despite being released in 1987, this Oscar-winning film remains incredibly relevant even after 36 years. It tells the story of Bud Fox, a young stockbroker who engages in illegal insider trading to impress Gordon Gekko, a ruthless tycoon. The movie gives a crash course in financial markets, showing how investors can profit from calculated risks. It explores the dynamics of supply and demand, the impact of news and insider information on valuations, and the importance of market regulators. Moreover, Wall Street highlights people pursuing wealth through unethical means, disregarding their responsibilities. It explores greed, moral decline, and the willingness to compromise values in pursuing money, power, and profits. At a deeper level, this movie prompts us to reconsider our relationship with money. Is greed genuinely beneficial, especially if it comes at the expense of others? No, you can use money for personal benefit without causing harm to others. Number 4. Willy Wonka and the Chocolate Factory. When signing contracts, thoroughly reading the fine print isn't the most thrilling task, but it serves a crucial purpose. In both the 1971 and 2005 versions of this film, the significance of paying attention to contract details is emphasized. The story follows the journey of young Charlie Bucket and 4 other children who win golden tickets to visit a chocolate factory. However, they must sign a liability waiver with complex legal jargon before entering. When accidents occur and the children are injured, the factory owner, Wonka, refuses responsibility. He goes as far as telling Charlie that he no longer deserves his prize, a lifetime supply of chocolate, due to breaching the contract signed at the beginning. In our everyday lives, whether agreeing to terms for an app or signing up for a credit card, we all relate to Charlie when signing legal contracts. Often, these contracts contain all the critical details from financial institutions, covering what they're responsible for, any benefits or perks they offer, specifics about investments, and the fees they charge for managing your account. However, this information is usually tucked away in the fine print, which can sometimes be confusing and complicated to interpret. In such instances, preparing and discussing a list of questions with the institution's representative before agreeing to anything is advisable. It's crucial not to rush through such critical documents. Always take your time to ensure you fully comprehend what you're committing to. Number 3. The Social Network. This movie portrays Mark Zuckerberg's journey in founding and growing Facebook into a global social media powerhouse. While this movie has numerous valuable lessons, I'll highlight 2. The first is that persistence plays a significant role in achieving success. While several people were part of Facebook's early stages, Mark Zuckerberg was the only one who remained dedicated till the very end. His incredible devotion and unwavering persistence were vital to his immense success. This commitment led Facebook to acquire major companies like Instagram and WhatsApp. This emphasizes the importance of continuous effort and unrelenting dedication toward our aspirations if we genuinely wish to achieve them. Secondly, achieving success demands considerable time and effort. There are no shortcuts to wealth unless one opts for questionable methods, which require patience. Eduardo Saverin, the original co-founder of Facebook, exemplifies this lesson. He sold his shares and departed once Facebook gained traction. While this decision brought some gains, staying longer might have led to significantly greater rewards. Interestingly, Facebook advertising originated from Eduardo's concept, which Mark initially disagreed with. Ironically, today, Facebook earns billions annually through advertising. Number 2, The Wolf of Wall Street. You might not expect a film centered on fraud to offer financial lessons, but The Wolf of Wall Street is filled with insightful money lessons. Its central themes explore greed, addiction, and corruption resulting from excessive materialism. The movie portrays Jordan Belfort and his associates engaging in unethical financial practices, harming others to satisfy their desire for wealth, power, and status. Belfort describes his actions as innovative, yet in reality, he is committing fraud. For instance, Belfort trains his team to sell investments without educating them on the investment's risks or their suitability for clients' portfolios. The focus is solely on pushing the product, a business model that still exists today, where financial companies incentivize their representatives based on sales rather than focusing on improving the financial well-being of their clients. Thus, it's crucial to be cautious of financial salespeople. While they may seem genuinely helpful, their primary goal is often closing a sale, not necessarily managing finances effectively. Number 1, The Big Shot. The opening quote of Mark Twain in The Big Short sets the tone. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. It's relatable because we often find ourselves firmly believing in something that turns out to be untrue. This movie isn't about the 2008 global financial crisis, but examines the events leading up to it and how a few individuals foresaw the disaster. One key lesson from the film is to rely on data rather than following popular opinions. Michael Burry, a hedge fund manager, tasks a recruit with examining each mortgage in top-selling mortgage bonds. Despite the complexity of this task, Burry goes through the data himself and identifies risky subprime mortgages within the mortgage-backed securities. This discovery led him to bet against the housing market and invest in credit default swaps. Burry sticks to his data-driven decision despite facing pressure, accusations, and ridicule for going against the widely accepted belief in the housing market's stability. Eventually, when the market crashes, Burry's strategy proves correct. Another lesson for investors is to guard against worst-case scenarios. Often, we overlook obvious warning signs simply because we prefer not to contemplate negative outcomes. During times of great success, we tend to embrace the momentum and lower our guard, which can pave the way for potential disasters. The movie illustrates this through the hot hand fallacy, where consistent success misleads people into believing an individual's streak of victories will persist indefinitely. For instance, before the 2008 crisis, banks and the housing market were deemed invincible. Only a few perceived the looming crisis, while the majority remained unprepared. When the storm finally hit, it caught many off guard. Numerous movies offer a vivid portrayal of money, how it functions, how it's made, and how to use it to build yourself. Like books, certain movies contain a wealth of information capable of greatly enhancing your financial knowledge. Not everyone loves reading books, and this makes films, documentaries, podcasts, and even audiobooks a viable option. The ultimate objective is to remain receptive to learning. While at it, remember that valuable lessons can be drawn from the triumphs and mistakes of the lead characters in these movies. There you have it, 7 movies with valuable money lessons. Have you watched any of these? Or is there one we've missed on this list? Please share your thoughts in the comment section below.